Hello and welcome to Kemet Capital, the community of holders and seekers of African capital. I'm your host, JS, and before we begin with today's capital reaction, we start with our usual public service announcement. Our guiding principle, our idea of affirmation is the Cobb Douglas function, guys, on our way to make Africa great again. Is through economic power, economic strength, economic might. And in order for us to achieve that is through efficient allocation of labor and capital. Today again, we're gonna react to this video pertaining to the total factor of productivity, which is the change in output, not from input. All right, guys, let's just move on to this video that we're gonna react to today. Again, from CNBC Africa. Let's jump in.
Finance Corporation launched the State of Africa's Infrastructure Report for 2025 under the theme Mobilizing Domestic Capital. This year's
All right, guys. For people that are new to the community, we have already discussed about the Africa Finance Corporation, which is the topic of the video that we're going to react to. To give you a little bit of a background, the Africa Finance Corporation is a multilateral financial institution that focuses on infrastructure development, industrial growth, and economic resilience across Africa. It provides financial project financing, advisory services, and structure investments to support key sectors like energy, transport, and natural resources. We already made a video focused on this entity, the Africa Finance Corporation. It's the capital capital talks number 7, I believe. So if you guys are interested to know more about Africa Finance Corporation, you can refer to that video. But today we're just gonna react to this one, and yeah, let's go ahead.
report explores how Africa can unlock trillions in domestic capital to transform sectors like energy, transport, as well as logistics. Samaila Zubairu, who is the president and CEO of the Africa Finance Corporation, joins us to unpack the report in greater detail. Samaila, thank you so much for your time. As I mentioned in my intro, this report is launched under the theme Mobilizing Domestic Capital. Talk to me about why this particular theme.
Thank you very much. I'm glad to be here with you. You know, we've always advocated for, I would say, African ownership of our development. And that development has to be funded by
100%, guys. You guys already know, if you're familiar with this community, if you're part of it, you already know we advocate for local capital for order to develop the continent. We shouldn't rely on aid or foreign capital. We should be pulling ourselves from our own bootstraps.
Africans themselves. So it's very important that we demonstrate what is possible to fund this. So our research this year looked at, our traditional themes in energy, transport and logistics, natural resources, and industry. But we wanted to draw attention to the domestic pools of capital that we have on the continent. And our research indicated that we have about $4 trillion of domestic capital pools.
That's a lot of money, guys. $4 trillion. So $4 trillion. That's a lot of capital that's just dormant. That needs to that needs to be allocated towards efficient and productive usage.
That could be available for our development. The large chunk of that, over $2.5 trillion, is in banking assets, which is not really available per se because it's a highly regulated sector, and with all the capital charge for long-dated instruments, it means investments in infrastructure and industry will not be as I would say as easy. However,
All right, guys, just to expand a little bit of that on that, banks, every time they lend $1 of money, they need to set aside amount of capital to cover that amount that they're lending or that they're investing. Most likely they'll be lending because that's the role of a bank. So what Sumaya is talking about here, it's the fact that banks actually are not really drivers of long-term investment since their capital is strongly regulated and they're limited in the you know the breadth of investment that they can actually seize and invest in. So that's kind of a nuance when you're talking about banking because of that regulation. The amount of capital that they lend has to be, supported by X percentage of, capital reserve.
There is $1.1 trillion in non-banking assets or capital pools, such as pension funds with over 450 billion, public development banks that comprises institutions like ourselves, over 220 billion, insurance assets over 300 billion, and sovereign wealth funds over $130 billion.
Wow, guys, that's a lot of money, guys. Let's face it, that's a lot of capital that needs to be deployed that can be invested in very productive type of investment, specifically in sectors like energy, transportation, and so forth.
So these are the areas that we think we need to find a way to target. What's interesting is that less than 2% of that is invested in infrastructure, which is where
It has to be more, guys. We cannot have that amount of capital and only 2% is invested in infrastructure. I'm sure the majority is going abroad investment foreign assets, which is a wrong the wrong approach. Our capital um, needs to be leveraged in order for us to achieve the development that we need and that we actually deserve, if I must say, if I say so myself.
I think the work needs to happen, and we need to direct, I would say, regulatory reform. You need to ensure that we have asset allocation for infrastructure, and also we have incentives for investment in infrastructure.
That's correct. We also need incentive for people to save more in order to increase that pool of capital.
Because in some countries, the investment in government securities is up to 100%. In those same countries, or in some countries, you have up to 10% investment in alternatives. But in some countries like Nigeria, you have specific allocation for infrastructure private equity, which is essential because the talk is that you don't have bankable projects.
Right, guys. Even pertaining to our previous video, Capital Talk number 6, we kind of highlighted the asset allocation of major African pension for sovereign funds. So maybe you can refer to that video if you want to have an idea of what type of assets those sovereign funds in Africa are actually invested in. And let me tell you guys, a very small proportion of the investment is dedicated to private equity and infrastructure, which are two main domains in that are critical for any nation that is trying to develop itself.
In Africa. And to create bankable projects, you need to invest in project development, project preparation, and it's equity capital that is typically used for that. So it's important for us to address this challenge of project preparation to create asset allocation to support that. And of course, we have infrastructure bonds, I think up to 15%. And then you have general private equity and venture capital for 5%. So allocations like this, help drive change. Why? Because if people know that there's capital allocated, then you would find, asset managers or professionals that are specialized in financial intermediation, come in and look at how they can build the right instruments that would channel the flow of funds from the savings to the products. As AFC,
And guys, in order for those guys to achieve that, they need to be informed. We need that financial infrastructure that we always been talking about in this community. Even last time we talked about Africans. We need information. Those investors that Somali or the CEO is talking about, they need to be informed. They need we need more financial information, and we need entities that will provide reliable information, because for any investment is as good as the information that you get from, from either the market or the product itself that you're trying to invest in. So providing reliable and critical information like the AFC doing right now with the study that they've done for 2025 will be critical. It needs to be more democratized. It needs to be more mainstream, and it needs to be more. It needs to be promoted at the end of the day.
We have done this ourselves. We have created InfraCredit, which is a credit enhancement or credit guarantee, program for.
And guys, credit guarantees are huge. Risk mitigants are huge, because some investors like insurance are limited in the type of investment that they can invest in, because they need to they're regulated in the type of risk that they can engage. Because it's a pension fund, you're talking about, you're looking after people's retirement, so it's critical. It needs to be like, sound investment. So with AFC providing risk mitigation or risk guarantees, it lower the risk of those long-term investment, and increase the availability of investors that can actually get into those projects, because the risk is lower now, so the regulation allows them to allocate capitals towards infrastructure, which is what we actually ultimately need on the continent.
Pension funds to invest in local currency in long duration assets. So typically, most of the investments on the continent are short term.
Short term, duration, if you get another word, duration is kind of the relationship, it's a sensitivity of an asset to the interest rate in general. So when you are long duration, that means you have long term views, and you have your risk profile is also higher, because you have a long term view. A lot of stuff can happen between now and then, compared to the short term, where we kind of have a view of we have a clearer expectation of what may or may not happen in the short term compared to the long term. In the long term, anything can happen. You can have, I don't know, Elon Musk now be the president of the United States, and something like that that can drastically change the view you had on your investment. So longer term is more it's riskier than shorter term. It's kind of intuitive as well, but it's critical for longer term asset holders or debt holders like pension funds, because the pension funds, their debt is in the future, right? They have to pay the beneficiaries when they go in retirement, which is some years in the future. So, to invest in those risks, in those type of assets, there needs to be, the risk profile needs to make sense for them to engage.
You need to create instrument for long-term investment. So InfraCredit is an example of that. It has been successful. And at the report launched today, the CEO mentioned that they've had no defaults. And in fact, some of the pension funds are now investing directly into the assets. And that's the experience that we also see. When we mobilize capital from other regions into the continent, we typically will provide credit enhancement for up to 100%. As time goes on, that credit enhancement is reduced, but we see participants coming to set up offices directly on the continent, which speaks to the fact that Africa is indeed viable, and the losses or the default non-performing assets are limited.
Wow, that's kind of counterintuitive. You might think that because it's Africa, lack of capital, lack of regulatory policy for it will actually be higher, but the CUE is telling us that it's the lowest in the world, 2% default rate in infrastructure product on the continent. That is an amazing and awesome performance. It needs to be, talked about more. It needs to be advertised more, because those are the type of information that holders of capital they need. They need to know that, okay, this asset type is actually profitable. 2% loss rate. It's actually awesome. Great performance. That means the guys, the project that they're investing in are actually profitable. They're generating revenue that allows them to pay back the investors. So all in all, great news.
I mean, all data indicates that currently Africa has the lowest default rate for infrastructure assets at less than 2%. The lowest across the globe. So again, demonstrating that we need to take the steps for the regulatory reform to channel domestic savings into infrastructure and industrial assets that are actually needed to grow the economy. One of the things that we have always talked about is the need for local value capture and local value retention. That is essential for job creation. If we're able to direct our savings to support infrastructure that would enable industrialization, we can create quality jobs. Those jobs that are created will pay more.
Exactly, and which is the productivity of labor, something that also has been discussed in the community. You want you don't want a lot of people making $40 an hour. You need a lot of people making $100 an hour. So you need to increase productivity. You need to increase the value added locally. So that's the sinews of war right there.
People that earn can save more. We can have, deeper capital markets on the continent. I mean, earlier on, you're talking about capital markets. So the savings pool contribute or lay the foundation for deep capital markets, which is why we think that it's important that we all focus on the regulatory reforms that are required for proper asset allocation and for the regulatory reforms that are required to support intermediation of the capital from these pension assets or insurance assets and sovereign wealth funds to the real sectors of the economy that are required growth. And we
Samela, if
know
I
that
may
with all the
interject
changes in the
there.
world, there will be a lot of growth emphasis on Africa.
So Mara is going off, man. The guy is passionate. You can tell. I like him.
And we need to ensure that we are working with partners to demonstrate that Africa is indeed viable and their capital can come and work with us.
Samaila, in which areas are you seeing underinvestment from your point of view, given the backdrop that you've just painted for us?
All areas. What are you talking about? All areas are underinvested on the continent. We basically have a virgin land with nothing, being developed, basically.
So, I mean, all of Africa is underinvested, frankly. So all of Africa is underinvested. So the issue is, what can we do, to demonstrate the viability of the various sectors, and how can we, mobilize capital to continue to work with us? So clearly, we have opportunities in energy, both, baseload energy, renewable energy, lots of opportunities there, and we don't have sufficient capital there. We have significant opportunity in transport and logistics. We have several rail projects that are under construction. We have several pipelines under construction. We have several industrial parks under construction. So I mean, all of Africa is available for investment.
Yeah.
We have
Yeah.
seen
The
and
entire
demonstrated
continent is
viability
available,
of certain areas,
open for
and we need to
business.
build on that.
Are there regions where we can, glean some learnings on how they've been able to effectively mobilize their domestic capital tools?
So, I mean, like, I give you an example. Even here in Africa, we have examples. So, in Nigeria, we've been able to create, the infrastructure credit guarantee scheme in partnership with the Sovereign Wealth Fund of Nigeria, the Nigerian Sovereign Investment Authority, and PEAGE, as well as other development partners from across the world, to create this scheme that provides guarantees for pension funds to invest in infrastructure up to 20 years. That is
Providing risk mitigation, products, it's also critical in any capital markets, guys. The flow of capital is also the risk mitigants of that capital, of that investment. It also matters and quite a lot actually.
an example. that has mobilized, I think, over $150 million, and it can grow. We're looking at a similar initiative in East Africa, and we are also having conversations with the partners in Angola and in Botswana for similar initiatives to be done. So we do have examples in Africa, and of course, the other regions of the world have done the same. And there are many, but I want us to look at ourselves, and let's look at what is possible locally. We have several funds out of South Africa that are investing across the continent, which is a good thing. So PIC, for example, the pension manager for the government employee funds in South Africa, is investing in the continent, investing in Nigeria, investing in several parts.
We need more of those guys. We need all those, African sovereign funds to invest, locally, so that we all, at the end, a continental market. And if we already have like a financial integration with providers of capital investing all over the continent, so there's a synergy, there's a need for the regulation to work together, since the capital is now amalgamated throughout the continent. So all in all, it's a great news. The idea of a single market starts from there. Capital needs to be allocated everywhere. It needs to be flowing, free flowing, ideally, but also flowing towards, most efficient and most profitable usage. And that for the entire continent, or not only for one country. So I'm very pleased to hear that from the CEO and the president.
Parts of the continent. That is the kind of thing that we want to see. Earlier today, Dr. Keeley of CPF mentioned a social safety security network of several African countries that are looking to create a Pan-African fund. That's another example that can be replicated. So we do have our own examples, and let's focus on our examples. Let's focus on what is required to scale them, and let's do the scaling.
As we do that, I mean, is there a way for us to be able to change the narrative? I mean, you talk about us focusing on ourselves. So how do we change the narrative so that there's still that appetite amongst ourselves to want to invest?
We just need more proof. We just need to show them what we're capable of. Honestly, there's not much we can do. We need to. That's why we need our as done. I think the next video is gonna be about Mo Ibrahim and Celtel. He was able to sell his company for $3.2 billion. And when he started on the continent as Celtel, he was most of the big foreign investors never thought that the continental uh, you know cell phone service will never be democratized and will never take off. Look at that company today. Celtel was sold for $3.2 billion, guys. An African company with African holders of capital. We shouldn't be afraid to show them that we're profitable and that we're capable on the continent.
In infrastructure on the continent?
So that's a very good question, and it starts with doing. So we believe that we have several projects in our pipeline that demonstrate African viability, and they're all performing well. And it's just to continue to do that at scale and to work with partners. So we have, maybe I'll give you some examples. So we are building a rice integrated industrial park. We started, as a partnership with the government of Gabon and Olam. We've grown outside Gabon into Benin Republic, into Togo, Chad, construction in
The African Finance Corporation guys, they're very involved. They're out there in the continent. They're doing their thing.
Nigeria, Cote d'Ivoire, DRC, Rwanda. Again, clearly Pan-African assets, and partnership with various governments in each of the countries, and right now we have Afrexim, True Feather as an investor in that entity, and we have other African financial institutions that are seeking to invest in that entity as well as international partners seeking to invest in that entity. That's an example, of how you change the narrative, because you change the narrative by doing, not just talking about it, and showing that we are indeed profitable, and we can deliver the returns. Another example I would give, is the fact that when I look at our AFC, we started humbly at $1.1 billion. Right now, we have over $4 billion in capital, with $14 billion in total assets. We've paid over $800 million in dividends. We've retained over $1.5 billion in capital. So again, demonstrating that Africa is indeed profitable and viable. So it's the examples that change the narrative.
Samaila, on that note, thank you so much for your time. That was Samaila Zubairu, who is the president and CEO of the AFC.
All right, guys. Sumaila Zubairu, great African capitalist. Very insightful conversation with him. See you at the next one. Bye.